Haynes Brands, 10.5% dividend yield.
10.5% dividend yield.
Well, Haynes Brands! It's a great dividend stock, and they have amazing underwear. Welcome back to Strongman Personal Finance. Heard some very interesting news from Jeremy Lefebvre. Now, I'm not going to be bashing Jeremy as much, okay? Because at least he's changed his tune for now until the clown market returns. But we got to talk about an interesting topic, Haynes Brands. So Jeremy's now all about dividend stocks. Dividend stocks are cheap. You should buy them. It's the future, bro. Dividends, my shark fins. And he mentioned Haynes Brands for having a very high dividend yield. But what Jeremy failed to do was some basic research. Now remember, I don't have time to research a lot of this stuff. I have a full-time job. It's tax season. I don't have time. Jeremy is supposed to be a full-time investor. That's his job. That's his lifestyle. He said it himself. He lives the investor lifestyle. Whatever that frickin' means. Frickin' clown. But he should at least do some basic research before he pumps out a video and talks about the great dividend yield of some stocks. Number one, dividend yield means absolutely nothing. And number two, some stocks that he was talking about don't have a dividend. Kind of like Haynes Brands. Let's read this little article that came out February 2nd, 2023. And we'll see how much research Jeremy Lefebvre actually did. Oh, let me guess, 0. He just filtered on high dividend yields, and he pointed this stock out in one of his videos. Shares of Haynes Brands Incorporated tumbled more than 15% in pre-market trading Thursday after the apparel maker said it scrapped its 15-cent quarterly dividend. It scrapped its dividend. As part of a shift in its capital allocation strategy aimed at bolstering its balance sheet and increasing financial flexibility. So basically all the dividend clowns that love to see the company give them cash got mad because they slashed the dividend. And this stock has been absolutely wrecked in the past year. I mean, holy freaking crap. It's down 66% in the last year. And it's down 72% in the last 5 years. Now, why are they slashing their dividends? Well, we could see that they got a lot of debt. So I went ahead and looked at their 10K, their most recent financial report, and I looked at their long-term debt. And we could see here that they have, as of December 31st, 2022, $3.8 looks like billion dollars of debt, almost $4 billion of debt. And it's always good, remember, it's always good to look at the maturity dates, because a company that has a lot of debt, if they don't have to pay back the debt in like 30 years, okay, it's not an imminent risk of bankruptcy. But if they have to pay back the debt soon and they have trouble getting new lenders, they're going to run into some trouble, okay? Now, we can see that Haynes has a lot of debt maturing very, very soon. As a matter of fact, it looks like they have a accounts receivable securitization facility, $209 million. And that matures June 2023. Then they have these senior notes, $500 million maturing June 2024. That's only 15 months away. $900 million maturing in 2024, and then the rest in 2026. So they have over $1.5 billion maturing within a year. Okay, within a year and some change. They're trying to pay off as much debt as possible. They can possibly refinance this, but they're probably going to pay much higher interest rates, and that's going to hurt their profitability. But of course, this freaking clown, Jeremy Lefebvre, just pulls up a high dividend yield stock and says, oh, it's got a high dividend, see? So now you can buy it. Look at this forward dividend yield, 10.5%. Now, is this company a turd or not? I really have no idea. I mean, you pull up the financials, right, and you look over the last couple of years, it's basically had flat revenue growth, okay? Looking at their profit margins, their gross margin has been basically at the same level, but it's trending down over the past year. Its operating margin has trended down. Its profit margin has trended down. Its free cash flow margin has trended down. And if you go and look at the free cash flow per share, look at it quarterly, let's look at the free cash flow per share, and let's compare it to the dividend per share. So over the last couple of quarters, they seem to have plenty of free cash flow, okay? And then all of a sudden, they started having negative free cash flow, negative free cash flow, negative free cash flow. But their dividends stayed the same. Now, that doesn't mean they don't have any money to pay their dividend. But with a bunch of debt maturing, so you should look at debt maturity dates when you're looking at dividend sustainability. Their debt's maturing soon, and their free cash flow was negative for the last couple of quarters. Yeah, the dividend was probably going to be cut, okay? So overall, I mean, you could put this into a DCF and do some calculations and figure out if this is a good stock or not. I don't really care what you do, okay? But this company is not a growing company. It slashed its dividend, which I think is a good thing to pay off debt. But a lot of dividend clowns aren't going to be happy about that, because dividend clowns like to see their fake passive income. So don't listen to freaking Jeremy Lefebvre. He's a moron. And he once again proved that he has no idea what he's talking about. Have a wonderful day. Cheers!